Shifting focus now to Russia's central bank, which has cut its benchmark interest rate to 14%, surprising markets that had expected policymakers to keep borrowing costs unchanged. Here's what the governor said.
Today, we decided to lower the key rate to 14% per annum. We view the observed acceleration in price growth as temporary. Our estimates of sustainable inflation remain in the 4 to 5% range. According to current data, business demand expectations declined in June. This may indicate more subdued demand in the future, limiting companies' ability to pass on increased costs to prices.
The move comes even as inflation has accelerated, driven largely by a sharp rise in fuel prices following the Ukrainian drone strikes on Russian oil refineries and fuel infrastructure. Annual inflation climbed to 6% in June. That's well above the central bank's 4% target, while petrol prices have risen 16% since the start of the year. The bank now expects inflation to remain elevated at 6 to 7% in 2026, citing higher fuel costs and rising inflation expectations. The central bank also lowered its outlook for the Russian economy. Officials acknowledge that fuel price increases are beginning to spread across a wider range of goods and services. Central Bank Governor Elvira Nabiullina said that refinery attacks and supply disruptions have created inflationary pressures. But she maintained that these are largely temporary shocks and that monetary policy will continue to focus on underlying inflation trends.
These are supply shocks, but what impact will they have on price growth? Yes, the current price increase is possible under the influence of these supply shocks. But what's crucial for us is whether these supply shocks translate into an increase in the persistent components of inflation. That is, whether they have secondary effects that will force us to respond with monetary policy measures. Because not every supply shock requires a monetary policy response. If it's temporary, transitory, and its effects are exhausted as these shocks pass over time, then monetary policy need not respond to them at all.
Ukraine's campaign has expanded beyond oil infrastructure to include attacks on Wildberries, Russia's largest online retailer. Multiple warehouse strikes have destroyed inventory belonging to thousands of small businesses that rely on the platform. Several business owners told Reuters that they have lost millions of rubles worth of goods, leaving them unable to repay loans, meet tax obligations, or finance future production.
For today, we cannot pay our loans because sales through Wildberries have stopped. Tax payments are not due yet, but they will be soon, and most likely we will not be able to pay those either. It is unclear what to do with it. In this situation, I am hoping for payment deferrals from either the government or the banks. If that does not happen, I could potentially become the next bankrupt business owner.
While the central bank says insurers have sufficient capital to absorb the losses, the attacks are adding fresh pressure to Russia's consumer economy. As the conflict enters its fifth year, rising inflation, slowing growth, labor shortages, and repeated supply disruptions are placing increasing strain on Russia's broader war economy.